Okay, we're going to go ahead and get started. Again, good afternoon, everyone. My name is Kerry Peoples. I'm the head of capital markets here at Bonaventure. Very excited to have you here with us this afternoon to kind of give you a little inside snippet of who Bonaventure is, where we've been, where we're at, where we're going. I'm pleased and happy to be joining me is the founder and CEO, Dwight Dunton, who founded the company 25 years ago. So we're gonna gotta talk about how we got here from Dwight and his family. Talk about the sponsor Bonaventure. We're gonna talk about the sector of what we specialize in, which is multifamily housing. We're gonna talk about the strategy, how we approach these markets, in our markets, particularly in the Mid-Atlantic and the Southeast region of the United States. And then we'll talk about a little bit about the structures of our current offerings in the marketplace, and we'll wrap it up with some Q&A. Fair enough, so we'll get started there. All right, Bonaventure was started 25 years ago. We currently have just shy of 3 billion of assets under management. Combined, we have 590 million of equity of sponsored capital invested. So Bonaventure has 590 million of their own money invested alongside your investors and our partners. We own and operate over 9,000 units. Together, we have a cumulative net IRR of all of our programs, about 36 full cycle events, around 24% IRR, equaling about a 2.8%, sorry, 2.8 times equity multiple. And I'm going to hand it over to Dwight and kind of talk about how we got here, Dwight.
Yeah, thanks, Kerry, and thank you everyone for joining us today. I'm super excited to share the Bonaventure story of who we are, how we got here, and where we're going, and how we think we do things that are really important to help building wealth for individuals and families. You want to move forward there, Kerry? Yeah. So, Bonaventure really came about because our family owned a piece of an apartment building that had been in our family for 40 years, and we were at a crossroads with our partners. And so we bought them out in late 99, early 2000, about 25 years ago. And we just continued the journey we had been on, which was to build long-term wealth through investing in multifamily real estate. And one of the key things that we decided was, we wanted to get rid of as many risks as we couldn't control. And if we needed something done and we couldn't find a vendor that could provide it at a level that we needed, and it was super critical, we'd build that capability. And so, that is really the fundamental principles of Bonaventure. We are a long-term, fixed rate, tax-advantaged investor that built an integrated full stack platform. And so what you see on here is our development business, which specializes in doing joint ventures with landowners, those families that have a great piece of land that wants to be something else, like an apartment building, but they don't have all the pieces to bring it to life. They partner with Bonaventure. Vest is our multifamily management platform based in Charlotte. Got almost 20,000 units under management. They manage most of Bonaventure's assets, but for a lot of other owners. And then the last example, I think, is really kind of encapsulates the Bonaventure mindset of how do we identify problems that maybe others don't see, and then cultivate unique capabilities that really bring value. And this was recognition that most people's internet experience at their home is not great, probably borders on terrible. That same providers provide internet in apartment buildings, and they make a ton of money and provide a really bad experience for all stakeholders. And we thought there's got to be a better way to do this for our residents, for our property staff, but also to have more economics captured at the property level. And so we created Internet Subway as our multifamily internet provider, and it's probably been the single best decision we've made. It's added about $80 million of value, $5 million of NOI, and our residents love it.
That's great, Dwight. And just to talk about, people talk about we were vertically integrated, and we truly are vertically integrated, and adding value in the marketplace, just like the internet subway, is just a huge factor and a huge bonus for us. So thank you, Dwight. Moving on.
Yep. So I touched on it a little bit a moment ago, but let me just dig a little bit deeper. When you think of Bonaventure, think multifamily, think tax efficient compounding. Um, and let me kind of walk through that. So we are apartment buildings. We've bought them, we built them, we've taken slightly older ones and renovated them. Every way to make money, but the backdrop is housing policy is broken in the United States. It is really hard to bring supply on in the places that people want to live because when they get there, the people that already live there say, I don't want any more rezoning. And the economic cycle oscillates. And so, if you understand the economic cycle and what goes on with housing production, there's always a way to make excess returns. And that's what we've developed the deep expertise, the 500 people that work at Bonaventure across all of our businesses. But it's not just enough to make the right business decisions and drive asset performance. It's really about how much do you keep, and that's the tax smart that we've developed. And we've done I think 1.3 billion of tax advantage transactions, and really stayed at that Holiday Inn Express of it's our money, it's our potential tax money, and how do we tell our silent partner, Uncle Sam, not this year. We're going to defer when we give you your share. And that's a deep expertise we've created, and it's a huge opportunity set for us to share with clients and families because everyone hates paying taxes. And we've figured out all of the tools in the tax code to do that. And the last bit is, my dad really said to me, you got to protect your downside. And if you can't control it, try to lay it off. And that was the basis for making that decision to just do long-term fixed rate debt because real estate generally trends up and to the right over time. The people that get hurt are the ones that have to refinance when there's no liquidity or NOIs are down. And so becoming a long-term fixed rate borrower, we became one of the largest borrowers from HUD, which is a terrible process. It's a government agency, but the end result is we have hundreds of millions of dollars of loans with 2 and 3% with 35 and 40-year amortizations. And it's a really good ballast to help us during those difficult times to be focused on asset performance versus fighting with the bank to not have them seize an asset. But more importantly, it provides the stability so that we can be opportunistic in those few moments when it's a great time to pick up assets in every cycle.
That's awesome. Thanks, Dwight. And you would say that combined with the internet subway is kind of a huge differential that separates us in the marketplace, correct?
Yeah, yeah. I mean, when we look at uh, acquiring assets, and we'll talk about that 721 UPREIT transaction a little bit. When we can go to an owner and say, you want to get out of your current property, but you have a tax problem, and you can fold into our property, and we'll give you, or into our fund, and we'll give you slightly below the value that you could sell it for, but you won't pay taxes, and our shareholders will get a little bit of that savings. Then we know we immediately have levers to pull to make that property more valuable. It's a really awesome combination.
It's awesome. Well, let's talk about the sector, the multifamily sector, and kind of the marketplace it is today in the Mid-Atlantic and Southeast region, and kind of where we've been the last 3 or 4 years in the marketplace, and how we've able to thrive in that marketplace when everyone else is kind of hurting a little bit, and where we're at
Yep.
today.
Yep. I think it goes back to uh, that long-term fixed rate financing. We have not had to roll any loans during difficult times, but more importantly, it's making the right investment decisions. And so while everyone in COVID said money's free, let's go build apartment buildings because everybody's moving to the Southeast, we said, you know what? These are 30 and 40-year assets. We're long-term investors. And some of these supply overhang numbers, like the number of shovels going in the ground, it is a future problem waiting to happen. And so we really are judicious in saying, we certainly want to see positive economic activity. We want to be in the states that are landlord friendly, that have low regulation. But most importantly, we need to find those submarkets where there aren't 1,000 shovels being put in the ground. What we have found is the best predictor of future rent growth is a lack of future supply growth. And so we avoided those markets. And so while you see headlines of Orlando and Nashville and Austin really struggling, to us, that was like a very obvious outcome that was waiting to happen, which was if you build that many units, you're going to have too much supply. And even though they had great job growth, there just wasn't enough demand to absorb it all.
That's awesome. So you say boring markets are not only a safe play, but it's been actually very beneficial for Bonaventure.
Yeah, and I think the biggest struggle we have is when you have investors who are casually, dabbling in the multifamily market space, and they say, "Well, I heard Charlotte's doing great." And they have lots of job growth, but the apartment market is terrible in the south end of Charlotte. Like it is horrible. But when I tell them Charlottesville, Virginia is the greatest apartment market right now in the southeast, they're like, "Where's that?" And I think that's the only struggle we have is people, you know, they don't necessarily understand the fundamentals of it, and so they follow headlines, which is, "Hey, my cousin's moving to a place. It'd be a great place to own apartments." Maybe. Or let's find a great place to own apartments, even if your cousin isn't moving there. And that's what we focus on.
That's great. That's great. All right. Well, let's move on. We already talked about the sectors and kind of where we invest, and let's talk about the stability and the purpose to build the capital stack and the kind of how we're structured a little bit.
Yeah. I mean, I think the key thing to long-term compounding is to never get wiped out. I mean, that is like if you go to Charlie Munger, Warren Buffett, the key thing was never lose money. And as long as you do that, you have the ability to come back and keep earning over a long period of time. And for us, that is about having really bulletproof capital stacks with long-term fixed rate debt, a lot of that amortizing so that it's paying down the balance, and then making long-term decisions. And so you'll see on here, our weighted average interest rate is 3.9%. Some of those loans are in the twos. And in 2021 and 22, we said, you know what? Rates are at 25 basis points or zero on the Fed funds. We don't have a crystal ball, but we think it's a pretty safe bet that rates are more likely to go up in the future than go down further. And we said, wouldn't we be really happy to lock in these rates for a long time? And so we refinanced every asset we could get our hands on that was refinanceable. And at the time we may have given up 15 or 20 or 50 basis points on a fixed rate versus a floater, but today we're 300 basis points, 400 basis points under comparable rates. And so that's that long-term focus, thinking about not what's going on today, but where do we want to be tomorrow, and build a resilient capital stack and turn your liabilities into an asset. And that's how we feel today about our debt portfolio.
Well, yeah, obviously that bet paid off with the average rate of return, I'll repeat, at 3.9%, which is absolutely amazing here.
Yeah. And the thing is today, in some of our loan assumptions that when we're acquiring an asset or doing an UPREIT transaction, there's still loans out there that we can assume that were put on during that period of time that are still very accretive. And they're probably lower leverage too. So a lot of investors, they're focused on getting the most leverage possible so they can inject the most risk so they can have the chance of the highest return. And I'd much rather say, you know what, I don't need a 75% loan at 6%. I'd gladly take the existing 50% loan at 3%. It's lower risk, better cash flow, and it's accretive to our investors, and it lowers risk. And yes, maybe in an Excel spreadsheet, you get a slightly lower return, but we think we're more than compensated for that by the lower interest rate and the lower LTV.
That's great. Well, let's go ahead and talk about some of the vehicles that how we invest and how investors and LPs can invest with us in the marketplace. So our BMIT, which stands for Bonaventure Multifamily Income Trust, is our perpetual REIT, and we have two share classes. First, the common share class and then the preferred share class. The common share class in the marketplace, which is a fee-based vehicle and pays a distribution with monthly NAV growth and quarterly liquidity after the first 12 months. So you just touched about a little bit on that portfolio, Dwight, and where it is today.
Yeah. This is our easy button for somebody who wants to invest with us. They understand the general theme and they say, you know what, you guys have been doing this a long time. I trust your judgment. And this is like a mutual fund of apartments. So this portfolio, again, got that long-term fixed rate debt, It's really low, below market. It's in those markets that are kind of boring. There wasn't a lot of supply growth, but they have really healthy NOI and rent growths. And they've got a conservative LTV. And so we've been able to continue to produce really good returns on a very conservative portfolio because of the asset quality, asset selection, leverage point, and interest rate.
It's great. And then we have a preferred share class that pays an 8% annual distribution paid monthly with no NAV growth for some of those who just are looking for an income play. And let's move on to a little bit of a bread and butter, and that's something that you're near and dear with your tax solutions, the
Yep.
1031, 721 DST solutions.
Yeah, I have my dad to really thank for this capability we've developed over the last 25 years because he was more persistent than most of saying, I am not going to pay Uncle Sam 1 cent more than the absolute bare minimum, which in his mind was usually zero. So it really forced us to have a deep understanding of the entire tax code. And the thing about real estate is it has amazing tools. Imagine if you could say, I'm selling all of my appreciated NVIDIA stock and roll it into, the next great thing, Micron, and just roll forward my tax basis in NVIDIA and not pay taxes on it till I sell my Micron. That'd be amazing. But you can't do that in stocks, but you can do that in real estate. And that's called a 1031 exchange. Or if you say, I want to take my stock portfolio and trade it in and become an investor in this mutual fund, is a really hard thing to do, but it's super easy in multifamily in real estate because that's called a 721 exchange. And so there's all of these tools that allow investors to be tax thoughtful to keep their money working for them rather than taking a 25 or 30% haircut on their profits, giving it to the government and only having 70 or 75% left to reinvest. And we've become experts in this, and we can provide 1031 exchanges. We can do that through a DST structure or whole asset. We can provide custom solutions. So if a client has a really large and bespoke need, we can custom craft that suit to fit them. Alternatively, if they have a smaller need, we can just give them an off the rack suit that looks kind of like a DST. I miss anything there, Kerry?
No, it's great. It's just like, I was going to touch on the custom solutions, but you already touched on that. For those who don't like or actually physically can't buy off the rack, you need a more customized solution like
Now,
myself.
not all of us are muscle bound like you, Kerry. I know you can't buy off the rack, but everyone gets it.
All right, let's get moving on. We did talk about a BMIT a little bit, and we talked about the common and preferred shares. So I would just give a little bit of an update of the portfolio today. I think this number's a little light. We're about 1.3 billion of assets. We have 133 million of sponsored co-invest. When we launched this fund in September of 2021, Bonaventure seeded this fund with 133 million of its own assets and own equity. And today we have 23 properties, just over 4,200 units, and our average occupancy rate is about 92.5%. You want to touch on or add anything to that, Dwight?
Yeah, I think we're all about talking to clients and investors, understanding what their needs are and how can we help them to solve complex problems. And I think the preferred share class was a great example of that, which was we're talking to investors and their advisors, and they're like, we get it. We love everything you do. However, we're an income focused investor and we understand the underlying fundamentals. We think it's a great portfolio, but we really need to focus on income. And we said, okay, what if we create a different share class and that is all income, no appreciation, no risk of share price fluctuation, and investors have loved that. And so we're really about saying, how do we not force everyone to be one size fits all to allow us to still do the thing we're great at, but provide different wrappers and different ways of investors accessing what we do.
That's awesome. Thanks for the color. We kind of the structure we have here was the common share classes for BMIT. Minimum investment is $25,000. Our current NAV is at $18.20 a share. That did start out in 2021 at $10 a share. Again, that is priced on a monthly basis. Our monthly distribution is currently 5.3%, which is tax friendly, tax sheltered, on an ongoing basis, or historically has. I can't predict the future, but historically has. But we anticipate that being the same as well. And our targeted rate of returns, we're looking for low double-digit conservative returns on an annual basis, and it's 1099 tax reporting on that as well. Preferred share class, the same. It's $25,000 minimum investment. It's a fixed share per unit. Doesn't change at $10 a share. Currently paying 8% annualized return on a monthly basis. And if you can convert into the common at year 4 at a 5% discount to NAV, and you could get out at par at year 6. Dwight, anything you want to touch base here on benefits
Yeah,
of 721s and
yeah. I mean, I think that uh, an UPREIT or 721 exchange is where you take one building that you currently own and exchange it for a proportional value in a larger fund. And it's a great benefit for both sides. The previous owner doesn't have to worry about paying taxes, finding a replacement property for a 1031 exchange. They get diversification. For our shareholders, it gives us access to assets that would not hit the market because the owner wouldn't sell them because generally they have a huge tax problem. And we become the solution, gives us diversification. Um, and it creates that long term alignment because those shareholders generally become stickier and stay around for longer because they have such a large tax hurdle to overcome if they were to liquidate shares.
that's great. And any of the DSTs that we future will come out in the marketplace and offer will have that optionality of doing a 721 exchange into BMIT if they have the option, or they could continue on and do an exchange, with another sponsor or somewhere else down the road. But they'll have that option after a year, say around, 5 years or so. Is that correct?
Yeah, we believe that the UPREIT transaction is a really powerful tool. It's great for a lot of people, not everyone, and so we want to really find the investors who are really interested in that, but then give them choices down the road to confirm that yes, this is what they really need.
Awesome. And we want to have on the sponsor side and Bonaventure side and from the Dunton family, a true experience that's just a great, exceptional from start to finish. Just some of our core assets, core plus and value added, some of our current properties in our portfolio. Dwight, you want to touch on some of these?
Yeah, and I think that this is a great slide to show how our business plan has evolved. So these are assets in BMIT. In 2021, it was buy core assets that were in the way of market growth. Then, as market rent growths cooled, some core plus deals that had a little bit of value add opportunity to continue to drive cash flow. And today, in the relatively slow rental rate growth market, we are moving towards assets where we can deploy marginal capital at really high returns to continue to grow cash flow, continue to grow asset value and NAV. And I'm sure the slide will look different in another year as the economic cycle and liquidity cycle continues to roll and the best way to deploy capital continues to evolve. But the good news is you have a portfolio that's comprised of all of these properties, so we're not overweight in one business strategy, one location. You're getting a mix.
That's great. Thank you.
Yep.
Just talking about the core benefits of each type of our slivers or offering or structures, when it comes to income and growth and tax efficiency, diversification, estate planning, hedge against inflation, lower volatility, liquidity provisions. It's all stuff that we could talk on a further one-on-one basis, and as you get to know and grow with us at Bonaventure. And we're gonna stop there for a little Q&A. I'll kind of move it here on my information if anyone wants to reach out to me directly. And we are going to go to the Q&A section.
Yeah. So I think,
Chat.
Terry, the way it works is participants, they can submit a question. It shows up on our screen. It will not be visible for everyone else, but I think we
Right.
got a few in here already.
You know, what structurally differentiates Bonaventure's platform?
Yeah, great question. I think one, it's the alignment. You know, we are the largest investor across our programs. So we think of ourselves first and foremost as investors versus being a sponsor. We think of ourselves as investors where our clients invest alongside of us. Two, our vertical integration, where we really are willing to roll up our sleeves and build the platforms that drive long-term value. And then three, it's that focus on multifamily tax efficient compounding with long term debt. You put all those together, and I think it's a pretty unique set of offerings.
That's great. Thank you. Next question. Another question came up. How does Bonaventure manage risk across cycles, particularly around leverage, interest rates, and refinancing exposure? Great question.
Yeah. One is realizing that it is a cycle and the economy and interest rates do go up, liquidity go up and down. And so to then have the humility to go, I do not have a crystal ball. And so I don't know when the economy is going to have a recession or when interest rates are going to go up. And so we need to build a resilient business plan. Generally, we want to get longer term interest rate loans so that we have more time to grow NOI. We generally want to have amortizing loans because that will reduce the loan balance that needs to be rolled over. And that's especially important if you're in one of those trough moments in the economic cycle. And the last thing is fixed rates. As we saw very dramatically in the last tightening cycle, like that can cause a lot of pain. And folks thought they had a crystal ball, but like you watched the television and no one in the Federal Reserve had any clue where interest rates were going or how fast inflation was rising. And so we just want to take all that off the table so we can focus on just running the wheels off of our assets and giving ourselves as much breathing room to overcome the unavoidable speed bumps in the economy.
That's great. Thank you. Another next question. How is alignment structured between Bonaventure and investors and distribution partners?
Yeah. I think we really think about when we're going to conceive an investment vehicle is creating the alignment between the asset, the business plan for that asset, the duration of that vehicle, the type of vehicle it is, and how we align our interests as a sponsor with the investors and their advisors. And we want to create as straight a line as possible through all those points. When we do that, we feel like it is going to be a great experience for the investors. Now, obviously, we have to perform. But that, that is the kind of ethos that we bring to every opportunity where we're going to deploy capital. And along the alignment side, one, we're putting our money to work shoulder to shoulder with investors. Two, we have an incentive compensation structure where when our investors win, we also win as the sponsor. And then we widely share that throughout Bonaventure so that we have people who are willing to go the extra mile when the world throws a curveball at our pro forma because they know they have to solve that because one, we made that promise to our investors, and two, they're financially incentivized to solve that.
That's great. Thank you. Next question. How should firms think about the different access points to the Bonaventure platform from suitability and supervisory perspective?
Well, you might have to help me here a little bit, Carrie. But I think one is access points. We know that one size doesn't fit all. And so we want to have different vehicles with different minimums, different durations, different structures around them. And then, some of our vehicles are aligned around an advisory account, others are aligned around a commissionable account. And then some assets are good for both. And we're thoughtful about it's not one size fits all. We want to make it accessible. What else did I miss there, Carrie?
That's right. No, it's true. We have different access points for, like I said, one size doesn't fit all. And for the broker-dealer community, we have certain structures, and for the RIA community, we have certain structures, and for the hybrid community, we have also certain structures as well. And then for the custom solutions, so we basically have touching points for everyone and to help anyone out with how they how the investors want to have their experience with Bonaventure.
Yep.
Next question, why is the 721 exchange a core capability for Bonaventure rather than a peripheral offering?
Yeah. I think one is for Bonaventure, we want to be in businesses where everyone and their brother isn't. And the complexities associated with doing a 721 mean that there's just not as many people doing it. So therefore, we can invest the resources to become great at it. And we have become great at it. And what it allows us to do is have conversations with existing owners and intermediaries about assets that would never come to market. And we feel like that's good for those current asset owners because we're providing a solution they can't get elsewhere. And it's good for our shareholders because we're able to procure those assets that no one else could, and generally at valuations that are at a discount to what they would have traded at for on a cash basis. And so it is truly a win-win for everyone and is a differentiated solution that really allows us to build a capability to be best in class.
Great. Okay. Well, last question. So we
All
keep
right.
it 30 minutes. So one more and we'll be wrapping this up. Where does Bonaventure typically fit within a client's broader portfolio construction? Would
Yeah.
you
Um, so I think one, it's about diversification. So most clients are not overweight alts, but they're generally overweight public equities. And so they're looking to get a little less volatility. They're looking to get a little less correlation. And then we definitely should not be in your liquid bucket because while some of our programs do have limited liquidity, the reality is the underlying assets on a good day take a minimum of 60 days to sell, probably 120. And multifamily is the most liquid commercial real estate asset class in the US. And so I think for some investors, they've gotten in trouble because they either got bad information or they assumed that limited liquidity meant unlimited liquidity. And so what we want to do is be that sector of that client's portfolio where it's a long-term compounder, it's a non-correlated return, and it's money that they're not going to need immediately because they have other sources to get cash to fund their known needs as well as their emergency funds.
That's great. Thank you so much. That's great. Great answers. Great questions, everyone. Thank you, Dwight. I appreciate it. And we all appreciate your time here
Yeah,
today. We're going to wrap this up. Thank you, everyone, for joining us. Feel free to email me with any further questions you guys might have or reach out to us at any state time, and we'll be in touch with some future presentations and some future webinars as well. So thanks,
yeah.
everyone.
Thanks everyone for spending your afternoon with us. Thanks, Gary.
You.
Bye.